Hi everyone, welcome back to another Realty Tuesday. Today we're spilling the tea on ways to improve your mortgage interest rate. There are a lot of things out of our control when it comes to riding the waves of interest rates, but there are still a few things you can do to help set you up for better success.
It's time for Realty Tuesday with Cheryl and Melanie, keeping you informed on all things real estate.
Melanie, let's dive right into it. Credit scores.
Hi, Cheryl. The number one thing that affects the interest rate is your credit score. The higher the credit score, the better. And the biggest thing you can do to have a good credit score is to make sure that all of your bills are paid on time with no late payments. There are other things that affect your credit score as well, such as credit utilization and the number of times your credit has been checked. This is definitely a topic we should dive into deeper at another time because creating a good credit score is not easy, and some of the things that you need to do to have good credit are counterintuitive.
Excellent advice, Melanie. Another thing to consider is saving up or using your current equity for a larger down payment to power your move. Melanie, can you tell us more about this and how much someone should plan on using for a down payment for it to actually affect their interest rate?
You're right, Cheryl. The amount of money that you're putting down does affect the interest rate, especially if you're applying for a conventional loan. You have the ability to put down a large amount of money. The ideal amount is 25% or more. I know a lot of people aim to put 20% down because that eliminates the mortgage insurance. But when you put down 25% or more, that's when it really begins to have a positive impact on the interest rate.
Great to know. I don't want that to scare first-time homebuyers, though, who might not have that type of money to put down. There are low-down loan programs out there. It's important to highlight that more money down can contribute to a better rate, but there are other options out there. Which brings us perfectly into the topic of loan programs. What should viewers keep in mind when exploring these?
There are a lot of loan programs available, and honestly, it's very rare to see a first-time home buyer getting a conventional loan with a large down payment. We live in an area with a very heavy military presence, so if you have VA entitlement, I would definitely encourage you to look at VA financing as an option. A lot of times the interest rate is better on a VA loan than it is on a conventional loan, even with zero down. The FHA offers as little as 3.5% down, and USDA allows zero down, and there are even some down payment assistance programs that you can use to help you cover the closing costs and the down payment.
This is why it is so important to have open discussions with your broker and your lender early on, so you can compare scenarios to see what works best for you. Real estate is not a one-size-fits-all. Property type. Melanie, does this also play a significant role in interest rates?
Yes, the property type does affect the interest rate. Manufactured homes, condos, and multifamily homes will usually have a higher interest rate than a single-family stick-built home. That doesn't mean that you shouldn't buy a condominium or a duplex or a manufactured home if that type of dwelling best suits your housing needs. It's just good to know what factors play into the interest rate that you might be offered.
These are all great things to consider when preparing to get the best rate you can. The last thing we might want to touch on is considering loan terms. Typically, shorter terms have a lower interest rate, correct?
Yes, that's true also. Most people get 30-year fixed rate loans, but a shorter term, such as a 20-year or 15-year loan, could offer you a lower interest rate. Keep in mind, though, that the payment will be higher even though the interest rate is lower because you're paying the loan off in a shorter amount of time. Another option could be an adjustable rate mortgage to get a lower interest rate, but keep in mind that it's called an adjustable rate mortgage because the rate is not fixed and it could go up. So if you want to explore that as an option, make sure you ask a lot of questions and understand how much, how often, and when the rate can adjust.
Great insights, Melanie. Thank you guys all for joining us today. Be sure to stay tuned as we're unraveling mortgage interest rates all through January. Next week, we will discuss buying down your rate. If you have questions or want us to cover a specific topic, drop them in the comments. Have a great day, guys.